Has Michael Burry just gone crazy? Yes, the trader known for the big short is at it again, selling all but one stock and loading up on puts just as the US 30-year hits 5% once again. So what does this all mean as we now have the largest level of shorts ever recorded on treasuries? Well, in today's video, we take a look at what this is telling us in terms of structure, potential overbought natures in the markets, and whether gold can actually come back in light of the last big move. Guys, there's a lot to discuss. Let's get into it together. These are some huge calls being made on the street. Stocks, commodities, and cryptos. Let's look at it right now. Well, welcome back, everyone. It's great to have you here. My name's Tom, and in today's video, we have a lot to discuss. It may look like a equilibrium or doji candle over the last 24 hours, but take a look what happened underneath the hood. For the first time in a while, we turned defensive. So what does all of this mean? In today's video, we'll take a look at the macro and, of course, the key levels and data together, along with what Michael Burry's up to. But just a quick reminder, if you're from Sydney, Australia, or you're able to attend, come to our 4th of June trading events, completely free. We've got drinks, we've got a little bit of food, and of course, we'll be sharing with you some amazing stuff. Also, it's great just to meet people in the community and for you guys to potentially network and meet lifelong friends. All right, let's go through what is happening as Michael Burry makes one of his biggest calls of all time. He has sold everything in his portfolio but one, which is the Estee Lauder, and he has then loaded up on the puts. Yes, he's betting against all these big names. He's going against Barber. He's going against NVIDIA with his largest position, and it looks like he is calling for another big short. Now, as we know, he's done this a couple of times over the years, and he's generally been a little bit wrong. However, is this time different? Well, let's take a look at the nature of this current recovery. And you might be thinking this is the most insane market of all time. But actually, it turns out after we sell off, we tend to recover with pretty quick movements. In fact, 23 trading days to get off the bear market low is pretty normal. And one of the reasons why this happens is because, of course, often you could call it a dead cat bounce. That is, the market gets ahead of itself and then potentially sells. Now, we've seen Paul Tudor Jones, we've seen other people out there, and I guess Michael Burry in some ways, now calling for the market to make a new low and that everything is about to turn incredibly bearish. And at the same time we see this, we now have treasuries with the largest short interest of all time. Yes, according to Subu Trade, we have now seen short interest just spike over the last week, and everybody is betting against US treasuries. But really, should they be? Well, over the last 24 hours, we actually saw a large trade come in, and somebody may have been trying to buy the dip. Now, while I don't like trading treasuries, I think they're more of a multi-month or investing process. It's interesting to see this level once again find some form of what we have to assume at this point is probably buying support. And it happens right as we hit new peaks on everybody starting to short treasuries and trying to get out of them. At the same time as this happens, we've seen a spike in markets like no other past that US-China news this week. And of course, semiconductors and technology leading the last 5 days. But something happened over the last 24 hours. We started to see the market turn defensive right at this potential call wall. And as you guys know, and we spoke about in the previous video, we talked about this 5,900 level on the stock market being a massive amount of calls and a huge amount of expiration. And at the same time, we're seeing the same thing happening with NVIDIA, Tesla, and some of the other largest options traded stocks. So while that's happening, while we're still at this resistance, we have utilities, the number 1 performer, gold stocks, the number 2 performer, and staples, the number 3 performer. And you guys would know they are defensive positions. So that's the first time we've seen this market turn defensive over the last 2 or 3 weeks as we approach near these highs. So could that mean that we're about to sell off? Well, one thing I just thought I'd throw in here was a quick random stat about healthcare. Healthcare has been getting brutalized. Of course, the administration in many ways going under after it. But according to Jason Gopfert, this is actually the 5th time healthcare has ever closed positive on a day it fell to its 52-week low. And the stats around that, not too many stats obviously, are very, very bullish indeed. So could that be another market that's actually turning defensive even in the state of all of this terrible news for it? Well, let's have a look at one of our favorite reads, the Bullish Percent Index. Posted this account over on our account and X, links in the description down below if you want to follow us there. And as you guys know, we've used bullish percent index several times on the channel to not only pick lows in markets, like similar recently, and also to pick potentially turning points as we get overbought. And whenever we go to this 75 level, which we just hit, we start to say, has this market topped off for now? Is it too overbought? Well, the same thing is happening on both the S&P 500 and of course the Nasdaq. And you can see here that often when you see the bullish percent index for the Nasdaq come through and it gets above that 80 level, you have to start saying, was that too fast, too quick? And there are many, many reasons why people are starting to believe this. The percentage above the overall moving averages, such as the 5, the amount of growth in leveraged ETFs skyrocketing over the last couple of sessions as retail FOMOs in, and of course the RSI being above 70 as well, which tends to mean, at least for a little period of time, we may be looking at some kind of lackluster return. And that doesn't mean the market is going to a new low. We don't know that at this stage. In fact, everything we've been suggesting over the last kind of 3 weeks has shown us that breadth thrusts are here to stay. 70, swag breadth thrust, and the DeGraff as well have people generally lining up to buy stocks. And why wouldn't they? When we look at even most of the stats, even in the worst case, if we now see sell-offs from this overbought RSI, it tends to lead into markets that while they do decline, in fact, 91% of the time they decline over the next 4 days. Remember, we're 1 day into this right now, so that'll be interesting. But generally speaking, if you look at something that's 1 month later, 2 months later, markets again tend to recover. And the worst sells that we've seen during these times are these here, including a 12% sell-off, which, is kind of bad, but still doesn't even take us near to where we were in terms of the lows. Now, some other reasons people are, of course, feeling quite bullish about markets: percentage of stocks above the 200 DMA. It's a big deal. When you break the 200 daily moving average, while pullbacks do end up occurring, generally to it or even below it, they don't tend to be the weakness that most people expect. And of course, we've seen this several times over the last decades, and they tend to be pretty good. Another factor for bulls right now is that since the 1950s, in fact, 1957, we haven't actually ever seen a market recover in the percentages that it's done so far while not making a new all-time high. In fact, the worst one was a 16% recovery with a new low. We've never seen something go to 17, 18% or even more without making a new high in that potential sequence. So could we be lending ourselves into a couple of decent months here and then potentially Armageddon? Well, this is, of course, what Michael Burry is betting on. He's betting on a huge shift due to tariffs and potentially just debt in the system. And he's going ultra, ultra bearish. Do you agree with him? Let us know in the comments down below. But maybe he's following something like this, which is a massive administration change that changes everything. And we know that the market tends to not like that over the longer term. In fact, Trump's first 100 days tend to be following that of Nixon, FDR, and some other presidents. And we can see here that while markets have recovered during those times, they've tended to have very bad late years. And this could also line up very nicely with that idea of the third quarter not being very good. So where are we right now in the cycle? Well, we've argued that we're in later cycle, which usually means we've got between 1 and 2 years more to go. And we started to think that late last year. So realistically, we're in the thick of it now. And if you have overlays, the most overlaid pretty much market that we can look at is this 1960s or the 1990s bull run, tech versus AI this time around. Now, we thought that we were in the 98 kind of narrative, which of course was a market that would recover back to the supply, then potentially drop down a bit and then recover up. But the US-China trade deal obviously rallied it through that point. And now we find ourselves around here. So are we more at a 96 level, or are we more just kind of near the end as markets blow up big time and then ultimately turn pretty bad? Well, of course, we don't know that yet, but we do use these overlays along with other tools. And one of the good tools for the bulls is that we've seen tech and semiconductors lead the rally, which is usually what you want to see. Large trades, no real updates here except for Bitcoin. We thought we'd just kind of show you the dark pool here at the top for Bitcoin, certainly a large transaction. And as it turns out, if you actually have a look at all the same sizes, so these are 565,000 share positions, these have all been the same size. So I would say it could be the same trader, maybe a trader going for a sell, trader going for a buy, trader clearing that buy, then making a decision that they want to get back into it because they're like, you know what, the price action looks like accumulation, and then possibly is this a sell? It's literally the exact same size position. So could it be the same person? Hey, it may be. Gold-silver ratio still holding, as you'll see later on today's video, although gold and silver both recovered off what has been a pretty bad sell on them in recent days. So let's have a look now at the S&P 500 and central bank liquidity. Central bank liquidity ticking up off Jerome Powell over the last couple of sessions. And could that tell us that the market is starting to get a bit more liquidity in it? That's lucky, because if we don't get liquidity at these points, I think we could be in for trouble. But the S&P 500 is making its way towards 59.50. And we know that this area between 59 and 59.50 seems to be where the resistance is. Now, in terms of if we see a sell-off, what becomes now the most likely level that we'll see the street try to reactivate in? Well, of course, it's the 5,600, 5,660. And the reason why, it was a supply becomes kind of a resistance area, and now this is a demand. So if the market comes back down, we have a lot of confluence sitting all over this exact zone. Now let's have a look at the US 500 in terms of futures. You can see here that it's still making its way up here on the 2-hour chart, coming back down over the last 24 hours. The Nasdaq actually having a pretty decent trade on it that was replicable and then going to a new high. So we still have a series of higher highs and higher lows and higher highs and no lower lows. So update the charts. The big thing here to look at is going to be 58, 40, 45 over the next 24 hours, 48 hours. If we sell underneath that, we've finally changed trend, at least on the smaller timeframes, 2 hours, 4 hours, etc. New options, high and low levels are open. And of course, the next resistance, we're getting towards that 59.30, 59.50 zone. Let's have a look at the options. The options tend to agree with us. We have a lot of calls at 5,900. We have a lot of calls at 59.50.
President Trump publicly criticized Apple CEO Tim Cook for expanding production in India. This led to a 0.9% drop in Apple's stock. Analysts suggest Apple needs to build in the US to mitigate tensions. Meanwhile, Berkshire Hathaway maintains its significant stake in Apple, indicating continued confidence in the company. Toyota Motor Corporation reported fiscal fourth quarter 2025 earnings of $3.39, exceeding estimates but down from last year. Additionally, the company is recalling 443,000 Tundra trucks due to safety concerns regarding reverse lamps, which could increase crash risks. NVIDIA Corporation is set to export 500,000 of its advanced H100 chips annually to the UAE, supporting AI server development worth $500 billion in the US. This agreement marks a significant expansion for NVIDIA in the AI sector.